This is my good friend Kari Brown with Redmond Mortgage, and today she is going to answer our questions and concerns and all the things about assumable loans, assumable mortgages. So, my first question is, can you assume any kind of a mortgage? Like, what does it mean?
Yeah, so an assumable loan is going to be based on who the lender is and if they agree for it to be an assumable loan when they originate it.
Okay, so I would know that from the very beginning when I bought the house and got the
Correct.
mortgage in the first place.
Yeah, so it's based up to the current lender. When you get the loan, when you buy the house, you'll see on your documentation, usually it's going to be on your closing disclosure,
Okay.
on if the loan is assumable.
And why would I care if it's assumable or not as a seller?
So as a seller, if you have an assumable loan and that means somebody else can take over the loan. If I'm selling my house and I have an assumable loan and I have somebody that wants to buy it, they could take over the mortgage and take over those payments. That's what the assumable is. Let me ask you, as an agent, would you market a home as having an assumable mortgage?
Sometimes.
Okay.
So, as you know, interest rates have been low over the last, how many years? 10, 12 years, right? So, a lot of people are sitting on mortgages with 2-3%, in that range. So, if you are wanting to sell your house and you currently hold a mortgage that is assumable and it has that nice low interest rate and it's a pretty big chunk of the sale price of the property, and yes, I think it's a great thing to offer to potential buyers. For example, I bought my house for $300,000 5 years ago. I have a 2.5% rate and my payments about $1,500 a month. Okay. I'm just pulling this out of thin air. Okay. Now I want to move into, I need to sell it because I'm going to move into another house. Right. So currently I owe $280,000 on the house, but the house is worth now $450,000. So I offer my assumable mortgage to a buyer. The buyer can now take on my $280,000 loan for the 2.5% that it was at. Then whatever's left over, they can either bring in cash or tack on another loan that's going to have a much higher interest rate. So overall, it's going to lower their total payments instead of if they took the whole, $400,000 at 7%. It's not as simple as that, though, is it?
It's not. It always sounds really good because people want to assume a loan that has a 3% interest rate, especially in this market.
Yep.
But what they forget, which is what you mentioned, is that if your balance on the mortgage is $280 and you want to sell that property for $400, somebody has to come up with the rest of that money.
Yep.
Because you can't just assume the loan.
Yep.
With the sales price being $400, right?
And you can't really get a first mortgage for that extra $120,000.
Correct.
Because you already have the first mortgage that you're assuming. And so you're end up getting a second mortgage for that, and then that's going to have an even higher interest rate.
Yes. So in those scenarios, you're going to have to be qualified firstly for the assumable. So say you had a USDA loan that you're going to assume. So you're still required to meet the USDA guidelines, correct? So with your credit score, with your debt to income ratio, you're still going to have to qualify based on the program guidelines. And then when you get the second to pay for the balance, if you're not bringing cash for the remainder, you would have to qualify with both of those mortgages.
So the assumable is really a great option for somebody who has a chunk of cash that they're going to put down. Because in that scenario, if I had the $120,000, probably $150,000 after all the costs and stuff, but if I had that cash, then I could assume the mortgage, pay the cash, and walk away with the 3% mortgage.
Yes. And one thing that people don't think about on the assumable is it is a much longer process than a typical purchase. So in a typical purchase where the buyer gets pre-approved, they go the traditional route of going to their broker, they do a 30-day. We can usually get it closed in less than 30 days. If you're going an assumable route, it's going to be 60 to 90 days.
Oh, wow.
So that is because you have a lot more people involved. So you have the seller's lender, right? So you have the seller having to do some grunt work. You have the their lender, who really doesn't have any incentive to just transfer the mortgage. So you're banking on that lender having an assumable mortgage department that runs very efficiently. And they're really not on any time restrictions.
Wow. So as a seller, that's something to consider before you offer up your assumable mortgage.
Correct. So I would say is a lot of times offering an assumable does get more people in the door
It
to
absolutely
look at the house. But I would argue if you have an offer for a typical conventional loan or contract, and then you had an offer on your house to assume, which one would you or your sellers go for? Would they go for the closing in 30 days or would they go for the 60 to 90 days?
Yeah, and that's hard to tell because the it depends on the terms of the contract for sure. But if compares apples to apples and my sellers want to leave and get into their new house, then they're going to take the early close.
Yeah.
Over the other one.
So there's a little more involved with the assumable. One program that is a little tricky on assumable is the VA program. So a lot of VA loans are going to be assumable, and the person buying the home or assuming that VA mortgage does not have to be a veteran. If the seller is having their VA loan assumed by a non-veteran, that means that their entitlement is still going to be tied up in that loan. So if they go to buy a new house,
because they're still the veteran attached to that loan.
Correct.
Not paying it, but their
name is
their
still
entitlements wrapped up there in
correct. So a lot of times when they sell a loan, when a veteran sells a loan, that entitlement gets released. So then they have that entitlement to grab from again. But if somebody else is using that entitlement and they go to buy a new house, they might not be able to afford the house they want, and their entitlement is going to be
they might not be able to use the VA loan.
Correct.
Yeah, that's a problem.
Right.
I mean, for some people.
So a lot of times if a seller has a VA assumable, they would ideally want another veteran to assume it and then take it over with their entitlement.
It gets a little complicated.
It does get complicated.
And there are a lot of agents out there who don't understand that a non-veteran can assume a VA loan.
Yes.
So that's an important distinction. It can be done, but it's probably not ideal for the seller as a veteran to do that.
It gets complicated, which is why you need some pros.
Yep. So, anything else about assumables that we all need to know?
On a great
Kari Brown, friends. She is with Redmond Mortgage. She's an awesome mortgage broker. And thank you.
Thank you, Paula.